Hello, welcome to this episode of Rich Insights. I'm Don Rich, Head of Investments for Esoteric Capital Markets. Today's topic is on market sentiment, right? We are looking at irrational exuberance on steroids right now, people. I'm telling you, this is something, right? The speed and the magnitude of this run-up that we've seen in equities, now particularly U.S. equities, but the speed and magnitude of the run-up is just mind-blowing. Now, if you remember back in late March, I was expecting a relief rally, right? We talked about it in a number of the daily videos. I was expecting a relief rally. But again, the speed and the magnitude of this relief rally, we have so overshot anything that I could have envisioned at that time. Or, frankly, that I imagine most people could have envisioned at that time. We were talking 35% run-ups from the March lows right now. This is just mind-boggling. To give you some idea how overbought we are right now, let's take a look at this chart. Here we're looking at the percent of the companies underlying the S&P 500 that are trading above their 50-day moving average. All right, the percent of the companies in the S&P 500 trading above their 50-day moving average. And you can see this black dotted line is the last observation here. It's an end of May observation, and it was at 95%. 95%. Check that out. All right, so this data series only goes back to 1991, unfortunately. But that still gives us 30 years of history to look at. And we've never seen anything as high as 95% of the S&P members trading above their 50-day moving average. It's never happened before. Just think about those the poor folks that are in that 5% category. Oh my gosh, what are they doing wrong? If they can't even catch a bid in this environment. So how do we justify that? Or can we? Can we justify 95% of the members trading above their 50-day moving average? Well, your first thought might be that valuations have to be unbelievably cheap for this environment to occur. They have to be unbelievably cheap. That would seem to make sense, right? Well, let's take a look at the valuations. Here we have the forward PE ratio on the S&P 500. And again, this is observation as of end of May. You can see we were just north of 24. All right, so the forward PE ratio is currently just north of 24. And we take that back in time, and the only time we've ever seen a number close to this level was during the dot-com era. All right. Again, markets have not been this expensive since the dot-com bubble. And had we had additional history, I would imagine we could take this chart back even further and we would see only numbers north of 24 on the precipice of the Great Depression. All right. This doesn't happen very often, people. The markets are just so overvalued. It's become comical. It's become comical. Wow. So we've had this massive run-up, as evidenced by the number of members trading above their 50-day moving average, and that's caused valuations to just go berserk. Again, something that we haven't seen since the dot-com era. Well, if valuations can't explain why we've had such a huge run-up, it must be because earnings are printing strong, right? We must be having some really impressive earnings announcements. Well, let's take a look at that. Here we're looking at positive earnings surprises as a percent for the S&P 500. And again, we can see the black dotted line here shows us where we're at as of the end of May. All right, the end of May here, the black dotted line. And we can see that we have been falling for the last 6 or 7 months. Right? Earnings surprises have been falling. Now remember how this game works, right? It's not real complicated. Corporations always lowball their earnings, right? As a general rule of thumb, corporations lowball their earnings so they can come in on announcement day and give us a positive result. Not real complicated, but that's the world we live in. But even that has proven impossible here the last few months. The number of positive surprises on earnings has been continuously falling. Wow. So valuations aren't the cause of the record number of firms trading above their 50-day moving average. Positive earnings surprises are not. Maybe it has something to do with expectations of future earnings. Let's see if we can get some insights into that one. Well, here is the time series of earnings for the S&P 500. All right, and again, the black dotted line shows us where we are at as of the end of May here. Now, what you can see is we are in an earnings down cycle. Let me say that one more time so we don't miss it. Down cycle, right? We're not in an earnings up cycle. Now, notice previous earning down cycles. They tend to last for months, if not years. All right? So we are in an earnings down cycle. So our expectation should be for earnings to continue to fall for several more months, if not for 1 or 2 years. Now, these earnings down cycles don't happen often. You can see the last time it happened was in 2015, during what most people call the earnings recession. Before then, it was 2008, the Great Recession. Right, we had a long, drawn-out earnings down cycle, and before that, it was 2001 recession. So we're in this earnings down cycle. Earnings are currently disappointing, and based on past behavior, earnings down cycle, we expect they're going to continue to have fewer and fewer positive surprises or more negative surprises. Valuations are ridiculous, and yet we've got a record number of companies trading above their 50-day moving average. So you put all those pieces together and you scratch your head, what's going on here? Well, I swear I can hear Dean Martin in the background. When I put all these pieces together, I can hear Dean Martin singing Pretty Bubbles.
Pretty bubbles in the air.
Pretty bubbles. There is no conclusion I can come to other than a bubble. We're in a bubble. Right? I don't care how much liquidity the Fed pumps into the system. There's just no rational explanation for the activity we're seeing today, right? For the valuations, for the price appreciation, for anything we're seeing today. There's just no rational explanation, right? This is irrational exuberance, and this time it's on steroids. Why do I say it's on steroids? Because we've just experienced the worst economic shock in history. All right, so had we had this environment during a normal earnings down cycle, right, when the economy expands and contracts, but this time the contraction rate is the greatest we've ever seen. So you put all those together, again, we got irrational exuberance, obviously, and we have it on steroids. The other thing I would point out is remember, we've had indications from the Fed, right? The Fed is starting to caution about these lofty valuations. And how often do you hear the Fed talk about the stock market? They only talk about it when things really get nuts, right? You remember Greenspan mentioned it quite frequently leading up to the dot-com bubble because it was such a huge concern. And recently, again, we've heard the Fed start making references. They're not using the term bubble yet. They're referring to lofty valuations and so forth. But the risks right now are so asymmetric, in my opinion. Right, the downside risk is so much greater than the upside risk. So I expected this relief rally. Certainly didn't expect the speed or magnitude of it. At this point, I would start going the other way. I would start playing defense. Right, it is far overdue. Right, the run up is overshot at this point. So we got to think about playing defense here going forward. All right, so that's our message for today. I'm Don Rich. You've just experienced a rich insight. I hope you've enjoyed it. May your beer be colder than the company you keep. We'll talk again soon. Thank you.